do the stuff to make it easy for you to succeed. There's a Bill Belichick. He's arguably the greatest football coach of all time. And he has a good quote that says, in order to win, we must first learn to not lose. So you got to put yourself in a position to not lose. And you do that by just don't swing for the fences. Don't go for the rural properties. Just stick to the base hits, the singles and doubles. Go after a not so sexy type of deal.
Good morning and great morning, guys. Welcome to another fabulous episode of Exit Strategies Radio Show. Hey, I am your host, Corwyn J, Melette, broker and owner of Exit Realty Low Country Group in beautiful North Charleston, South Carolina. Guys, hey, if this is your first time listening to the show, hey, you know what it is, but I'm going to tell you anyhow, which is our mission. We got a mission right here, is to empower our community through financial literacy and real estate education, guys. We're legacy building. That is what we do. Always got to give a shout out to those people who I love, who say they love me. And we're going to start with my mama. So got to give a shout out to my mama out there in Monkey's Corner, my people all the way back through Hollywood, Pastor Vanderbilt Evans Sr., that guy will jack me up if I don't get it right, and his wonderful bride, Miss Sandra Evans, and also the McKellers, the LeCues, guys, you rock. And my folks that's listening in the Marion and Mullins area, the Troys, and the list goes on and on, guys. Thank y'all so much for tuning in. Look, I'm super excited about today's show. Look here, we always like to talk about money. And I say it like real calm and soft this time, but y'all know how I normally say it, which is money. So we have today none other than William Harvey. Now, Will, as he likes to go by, is the founder and principal of Harvey Capital. So he leads Harvey Capital, which is a real estate investment firm that is focused on both active, and we know what active is. That's where you're working in passive strategies across private and public real estate markets. His experience includes hard money lending, house flipping, hospitality assets. So I want y'all to pay attention, get your pencils, your pens, your paper pads, whatever it is. Let's start making notes, multifamily investment and note acquisitions. He brings a practical and operator level perspective and is known for identifying opportunities created by valuation gaps between public and private real estate sectors. So why is he here today? Because he's going to share some of that information and knowledge with us all. So I'm super excited to have him, and I ain't going to take any more thunder from him. Will, how are you doing today?
I'm doing well, Corwyn. Thanks so much for having me on the show.
You're quite welcome. You're quite welcome. So if you don't mind, look, I done told him a little bit. Maybe I went out and just started clearing out some dirt, but I want you to pave this road for us today and tell our folks high level who you are and what it is that you do.
Yeah, that's definitely a loaded question. But no, so I've been in real estate about 10 years, a little more than 10 years. I got into the mortgage business in late 2015 after I was a double college dropout. So the first time I dropped out was actually at the University of South Carolina. I dropped out to get sober and came home, lived with my family, and it was one of the best decisions I ever made. And then I ended up going to a school in Ohio to play football and had double hip surgery for a short while there. So that was the end of that. And I came home and got into the mortgage business. And a little while after being in the business, I started buying property, and it was an awesome run as a loan officer. I really enjoyed it, was able to build a strong, solid nest egg and buy some property and just kind of be able to jump into real estate full time after I did that for a few years. So late 2019, right before COVID, I jumped out and started a house flipping company with a partner. And that was great. I also was doing syndications where I would invest as a limited partner into large apartment projects and things like that. And ended up doing a few deals myself as an operator with another partner. And then we also had limited partners. We bought a wedding venue, a small hotel. And naturally over time, I just kind of migrated to the finance side of things. I realized that I don't like being a landlord. I don't like dealing with tenants. I love tenants. I just don't like dealing with them. And so I just kind of migrated to the finance side and just realized that's really what I enjoy. It's what I love. I love being in an Excel spreadsheet as opposed to being out running around fixing toilets and doing that whole thing, which some guys love. We loan money to guys that have hundreds of properties and they love that. And I look at what they do and I get anxiety just thinking. But for them, it's what they enjoy. And yeah, so that's what I did. And I started a small fund about 3-ish years ago. And we stumbled into hard money accidentally. I had a former coworker from when I was in the mortgage business. He called me and he's like, "Hey, I got this borrower that he lived in Ghana and went back and forth between here and Ghana. And he's like, he can't qualify for anything, but he makes great money and he's putting down 75%. And yeah, so he was putting down 75%. My buddy asked me if I would do a first lien hard money loan, 25% LTV. Before he even got done asking me, I was like, yeah, I'm in. No, no. And that was how we started doing hard money. And then fast forward about halfway through last year, I launched a dedicated hard money fund. And that's my focus now. It's one of my main focuses, I should say.
That is priceless, man. 25% LTV, man. Yeah, look here. Man, look here. As soon as he said 75 and look, it should have been right then immediately,
Oh, man.
right? So, Will, we're very diverse, right? Like, meaning from experience levels, etc. What I want to get out here early is how to get in, meaning the cost of getting capital, those entry points and such when someone's looking to borrow money for an investment purpose. Because most people always want to go the traditional lending route, right? That's what we've been conditioned and trained on, but everybody doesn't fit that. I just had someone in as recent as today. Hey, look, they don't fit a traditional mold. We need other options, and boom. So let's talk about that. What does that look like? How do you get in? What's the entry point?
Yeah, great question. So when I can speak from my own experience, the first house flip I did was also an accidental thing where somebody that I knew, this is at the tail end of my mortgage career, and it's the person that I ended up forming a house flipping company with a few months after this. But he calls me and he's like, "Hey, I got this opportunity. I want to see if you're interested in it." I didn't really know what he left me a voicemail and I called him back and I was like, he's probably wanting me to invest in like cryptocurrency or something like that. And anyways, I called him back and he's like, "Hey, I got this lead on a house flip and I think we can buy it at a pretty good price." And he didn't have a ton of cash and he knew that I was in the mortgage business and could probably figure out where to get the funds for it. The house was not lendable by any traditional standard. Any traditional type of loan just wouldn't fly with the way the condition the house was in. So we needed a private lender. We needed hard money. So I started just talking to people and learning about it. And like you said, people don't know that this exists. And a lot of people, when they hear hard money, they're like, 12% interest rate? That's insane. That's usury. But when you understand that this is short-term capital that doesn't exist because the banks and the lenders, there's really a gap between there's plenty of loans you can get if the house is in good condition and you have good income and all that. But if you're newer or if the house it needs work, and which the ones that need work are the ones that you're able to buy at a discount and make money on. So it's this catch-22 where it's hard to get financing for them, but if you can probably do well. So I talked around to some guys when that opportunity came about and I was quoted 3 points and 12%. That sounded crazy at the time, but it's not once you understand that it's only for a short period of time. And what I did and what I would tell your listeners if they're newer and want to get into this is try to figure out what you bring to the table. The guy that brought me that deal, he had a background in building homes and renovations. I don't know how to swing a hammer. So that was perfect because I didn't know any of that stuff. And on the flip side, no pun intended, he didn't know anything about the finance side. So it was this perfect marriage where each of our skill sets complemented each other's weaknesses. And that's how we got into that one. So I hope that answers your question there.
Guys, wealth building starts with understanding how money works and having the right strategy behind your decisions. That's exactly why Melefund Capital exists.
You found the perfect property. You got the vision. Now you need the capital. At Melefund Capital, we specialize in funding real estate deals for investors who want to build, blip, or hold and don't have the time to chase after banks. Whether it's new construction, a fix and flip, or long-term rental, we offer simple terms, fast approvals, and access to private capital. We even work with manufactured housing projects because we know what it takes to build value from the ground up. Simple. You bring the deal, we bring the money. Visit mellifundcapital.com or call 843-619-7038 to get pre-qualified today. Mellifund Capital, we fund what you build. Yeah, man. Yeah. So let's break off into another subject here. That obviously I say subject, but clean this a little bit further, a little bit wider. So private financing and ownership. So once somebody determines, okay, look, this is a route that I'm going to take, because people may say what they say in regards to where rate, whatever, and all that stuff is, and we can appreciate that. But the reality is, if the rate is this, but you still going to make this return, or the option is, I can get a better rate, but I can't get the deal done, which means I make no return. What are you going to do?
Exactly.
So you touched on some of this, but I want to go a little bit deeper with it. What are the risks? What does that look like? Because the reality is, wealth in real estate isn't built from just one approach. It's shaped by having different strategies and being able to balance both stability along with achieving growth. So, Will, this is probably a good place to get into like the next point here, which is opportunities and what does this all look like between private lending, et cetera, the risk, returns, potential, involvement, all that stuff. So I want to get this out because we want people to understand that wealth in real estate isn't built from just one approach. Sometimes you got to figure out the different strategies and also incorporate or attempt to balance both stability, because you want to be safe and have less risk, but also the growth component of it. So from both financial as well as consumer perspective, what are the risks involved in leveraging private capital for real estate?
Yeah. So on our end, the risk is that we loan someone money and they run out of funds, they go into default, they're not able to pay us back, and then we're stuck with we have to foreclose on a property or force a sale of a property. We're not able to recoup the balance of the loan. And then obviously the risk on the borrower's end is that they run into problems. They either have to sell it at a loss to get out of it, or they have to walk away from it. But I would say that any private lender, when they're doing a deal with someone, the private lender is loaning them money and there's a contractual relationship there, but they're partners in a sense, and they are both rowing in the same direction, and I want the deal to go just as smoothly for the borrower as they do, and I want them to make a ton of money, because that means that we're able to collect interest payments and everything's smooth, and we don't have to put anyone in default or anything like that. So my background as a former house flipper, I don't know, 13 or 14 houses, that allows me to look at a deal and really understand, is this a good deal? ARV is the most important thing. So someone estimating the value of the property once the work is done, that is your most important figure to get right out of everything else. You can screw up every other metric, and as long as you're conservative on the ARV, then you're probably going to be okay.
So let's take this and even shift it around a little bit more. And essentially what we're doing, we're just going around the bowl, but each time we go around the bowl, let's go a little bit wider and bring a little bit more in. Typically, if we're established that private capital is the route to go to get a deal done, understanding what the risks are both to the lender helps to understand or provide context to what the risk is to the consumer. What's the buy-in? Like, what is the typical minimum amount someone needs to be targeting to be able to get a deal done?
You mean to invest in a fund or something like that?
Well, let's say they're looking at a deal. So let's do both, but let's say lender side as well as consumer side, looking at a transaction, looking at an opportunity, and they want to get funding. Like, how much money do they need? But then also from the other side, they're looking to invest or otherwise be a part of a fund. What does that look like?
Got it. So from the consumer side, I know you're going to hate this answer, but it depends. We are very, very deal focused. We're an asset-based lender, of course. So the project, the deal, that all has to make sense. And if somebody is buying a property for pennies on the dollar, then that's going to outweigh how much cash they have in their bank account. Whereas the opposite is true. If they're doing a deal and we're not crazy about the area, or the LTV is a little bit higher than we would like for that specific area or that type of asset class, then we probably want to see a little bit more skin in the game, a little bit more cash and reserves. So it really just depends. In that, if you had a home run deal, obviously we're going to want to make sure that there's enough liquidity there to cover the payments and all that. But if somebody newer has a home run deal, I mean, my buddy that brought me the deal that we did 7 or so years ago, that was a home run deal. We made every mistake in the book that you could make. We over improved it. We just did everything wrong. The timeline went way longer. The market kind of shifted because things went so long. It was just everything that could have gone bad went bad. And we still ended up, we bought it for 170,000. We sold it for 300,000 and we made 50 grand. So we thought we were going to make closer to like 80 or 90, but we certainly weren't complaining making 50. So on that one, neither of us really, we had some reserves, but we weren't crazy flush with cash at the time. And it worked because it was such a good deal. And the lender that we talked to about it, he liked our plan. He liked what we were going to do with it. And he decided to do it. Now, on the investor side, on the lender side of things, if you're wanting to get into hard money, that really depends on the market. So we're in Richmond and we do some loans outside of Richmond in the Lynchburg, Virginia area. And, our average loan amount right now, it's probably going to go up because we've been doing some loans recently for this guy in Lynchburg and it's a lot cheaper there. But our average loan amount right now is around 130, 140. But up in Northern Virginia, closer to DC, it's a lot higher than that. You're probably having to buy as is around 250, 300, maybe even higher. So it really just depends on the market that you're in and where you want to lend.
Makes perfect sense. So always like this one is probably, you touched on it. So let's swirl the bowl a little bit wider yet again. The common mistakes, man. Like you say, you did the first deal, quote unquote. I mean, you great situation, but everything went wrong and you still came out well. But what are those mistakes? Let's have it, man.
Yeah. I could write a book on making mistakes. So again, the biggest one is getting the ARV wrong. There's a borrower that we have not loaned money to, but he consistently sends me projects he wants to do, and the ARV is just always inflated. The comps he uses are never good. And I would just say that having an understanding and knowing how to comp a property well, not dealing, if you're newer, don't mess around with a rural property. Those are tough to comp. The valuation range is a lot wider than a property that's in a more cookie cutter neighborhood. So do the stuff to make it easy for you to succeed. There's a Bill Belichick. He's arguably the greatest football coach of all time. And he has a good quote that says, in order to win, we must first learn to not lose. So you got to put yourself in a position to not lose. And you do that by just don't swing for the fences. Don't go for the rural properties. Just stick to the base hits, the singles and doubles. Go after a not so sexy type of deal. That's that kind of workforce housing, first time buyer type of neighborhood. That's what I would focus on. And that's what we did focus on in that first flip. And it went well. Now, mistakes, you can over improve it. We did that. Again, we were the neighborhood was not great. It wasn't a terrible neighborhood, but we went all out on the renovation because we thought that's just what you should do. And it would translate to making more money, and certainly didn't. So we learned from that one to go to just analyze your end market. Who is your buyer going to be? What area is it in? And then do the renovation according to that. Don't cut corners. Don't be cheap. Always fix everything that needs to be fixed. But you don't need to do Viking appliances in a neighborhood that is 300,000 and first time home buyer. You know what I mean?
Yeah, look at appliances cost more than the house.
Exactly. Yeah, you don't need some crazy backsplash. We did all that stuff. And it was just, looking back, we were like, man, why did we do that?
So thank you for that. Because one of the things, Will, that we oftentimes talk about when we're talking in this particular arena is some of the things that you mentioned, but usually just simply from the investor standpoint, but not also incorporating what the lender's position or standpoint on these things are. Rural properties are a lot more challenging. And then also got to understand how you do your comparables man, we run into this. People are taking numbers from you know what site and giving it to you like, well, look, that's not right. Or whatever that is and all kind of stuff. So yeah. So thank you so much for that particular clarity in that matter. So you also touched on and touched in the hospitality field. We see a lot of people that are interested in whether, not Airbnb, but have an event space or this, that, and the third. Tell us about your experience for that. What did you do? The experience that you had and what advice you would give to others?
Yeah, so I actually started doing Airbnb out of the house. I was house hacking. I had a tenant, he lived in the basement and he moved out. It was a townhouse it was my first house and I had no wife, no kids. So I wasn't really worried about strangers coming and staying with me. So I started doing Airbnb and it was a pretty cool experience. I learned a lot about hospitality doing that. I did it for a few years at that house and then bought a few more, did it there as well. And once I got married and my wife moved in, that was sort of the end of that. But that was cool. And that gave me enough knowledge to feel confident partnering with someone who had the main knowledge. He had run hotels and flipped hospitality projects, and our families are friends. So our parents are friends, and he's a few years older than me. We didn't overlap in high school or anything, but we reconnected several years ago and we got together and he said, "Hey, if I find any of these kinds of deals, would you be willing to partner?" And I said, "Yeah, I like the space." And so that's what we did. The first one we found was not long after we met. And it's actually this property here. It was this motel that we bought and
Oh, wow.
we put a couple $100,000 into it and rebranded it and just kind of systematized it. And it runs like a well-oiled machine now. And that's the thing with hospitality is that you got to be a systems person or you got to partner with a systems person because it's high touch. There's a lot of management. You got to have all those systems. You got to have a lot of tech in place. And if you do, it can be a great business to be in.
So let's take this moment right here to make sure we get your contact information out. So where can people find you, connect with you, Will, from the show so they can connect with you, man, ask questions, what have you. So how can people reach you?
Yeah, they can just go to my website. It's harvey-capital.com or just email me, will@harvey-capital.com.
Perfect. So the next thing that I want to touch on is this. You are a person of faith, and I want to kind of run this one, if you will, as we close out the show today. But you focus on being faith-driven and being a good steward. And your mindset is a reflection of that. And with that, what do you say to other people? Like I have a few clients, one in particular that pastor and wife who her ministry is renovating and reselling homes and things because she remembers when she had a difficult time being a single mother trying to find, housing, decent quality housing. So if somebody says something wrong, she fixes it. That's it. How would you convey the mindset that you have to others? How would you explain it to others as far as what they may be planning on doing?
Yeah, as far as my faith goes, my wife and I, about 2.5 years ago, really committed to deepening our relationship with Jesus and growing closer together and praying out loud. We do that every night. And we've just really tried to draw closer to the Lord and be intentional about it and infuse that into everything we do. So it's not really as compartmentalized as it used to be, where going to church on Sunday and the rest of the week is work and all good stuff, but we're not really actively living out our faith. And now I pray about this and I struggle with this. I struggle with sharing my faith, but I try to be bolder about it. And I pray that I am. In my investor updates, I sign my name in Christ instead of like sincerely or something like that. So I really try to make an effort to do that. And I think that my wife and I, we live fine. We're pretty frugal people and there's no more that we could get from increasing our income or anything like that. There's only it would do nothing to increase my happiness level or anything like that to make a little bit more money. So what I'm focused on now is really trying to generate wealth and resources and use that to try to help initiatives that are actively trying to spread the gospel throughout the world. And I really have a heart for people in unreached places throughout the world that don't have access to the gospel and the organizations that are trying to get the gospel out to those folks. So that's really something that I try to focus on.
Well, I appreciate you sharing that. When I saw that in the show notes, and as far as about you, I had to, because what we do and what people in business do altogether is difficult and challenging enough. But we also make an effort to have to remember, hey, wait a minute, let me stop, let me consult with them before we go forward. Sometimes we're so gung-ho about whatever it is. So I appreciate you being open and sharing that. So, Will, as we wrap up today, for our listeners, guys, I want to drop these, and they're not nuggets, because Will has already dropped the nuggets. I'm just telling you where to go back and find them. Because our takeaways for today, guys, is about you understanding how financing structures can assist you and influence the true costs of your real estate decisions. So I think we nailed that. And about evaluating risk and transparent when choosing your lending and or investment partners, as Will has mentioned as well. And then also, obviously, working to build your reserves before expanding investment and other commitments as relates to home ownership. So, Will, again, I want to thank you so much for taking time out of your busy schedule to be on with us today. For our listeners, look, hey, in real estate, long-term success isn't defined only by what you own, but how wisely you manage the capital behind it. And you guys reach out to Will Harvey over at Harvey Capital so he can help you in managing yours. So again, Will, one more time, thank you from the bottom of my heart for being part of the Exit Strategies Radio Show family. We appreciate you so much.
Thank you so much for having me on. It's such a blessing. I had a lot of fun.
Thank you. For our listeners, guys, look, you know how this thing here go. You know what I say, you know what I do. Always give it back to you, which is in telling you that I love you, and we're going to see you guys out there in those streets.